Did you know that the UK's economic trajectory in 2026 is being defined by a precarious balance between stabilising inflation and a stagnant productivity growth rate that has challenged the Treasury for years? As of today, Monday the 22nd of June, 2026, we are seeing a critical juncture where the Bank of England's monetary decisions are directly colliding with the daily lived experience of millions. We aren't just talking about abstract percentages. We are talking about the actual purchasing power of the pound sterling and how the current GDP growth projections for the second quarter are shaping the investment climate. In this update, we will dissect the latest financial data and, more importantly, the social ripple effects that these numbers create across the four nations of the UK. The Bank of England's Monetary Policy Committee has been under immense pressure to manage the base rate to curb persistent service sector inflation. While headline inflation has dipped compared to the peaks of previous years, the core inflation, which strips out volatile food and energy prices, remains stubbornly high. This means that while the cost of a basket of goods might seem stable, the cost of services, from haircuts to insurance, continues to climb. For the average homeowner, this means mortgage renewals are still a primary source of financial stress. We are seeing a trend where fixed-rate deals are shifting, forcing many households to migrate to higher rates, which effectively reduces the disposable income available for consumer spending, thereby slowing down the broader economic recovery. The UK housing market in June 2026 is characterized by a severe supply-demand imbalance that has pushed rental prices to record highs in urban hubs like London, Manchester, and Birmingham. Current data indicates that the average rental increase in the southeast has outpaced wage growth by nearly double over the last 12 months. This has created a generation rent crisis, where a larger percentage of monthly income is diverted toward housing, leaving less for savings or investment. Furthermore, the lack of affordable social housing has led to an increase in precarious living conditions, pushing more families into overcrowded housing or temporary accommodation, which has a direct negative impact on mental health and educational outcomes for children. Looking at the labor market, we are seeing a paradoxical situation. Unemployment remains relatively low, yet underemployment and in-work poverty are on the rise. Many workers are taking on second or third jobs, the gig economy expansion, to keep up with the cost of living. The wage price spiral is the primary concern for economists. As workers demand higher wages to survive, businesses raise prices to cover those costs, potentially fueling further inflation. Specifically, sectors like healthcare and social care are facing acute staffing shortages, leading to increased reliance on agency staff, which drives up public spending and puts further strain on the National Health Service budget. The government's current fiscal strategy focuses heavily on infrastructure and the transition to a green economy, but this comes with a significant cost. The allocation of funds toward net zero initiatives is essential for long-term sustainability, yet in the short term, the transition costs are being felt by small and medium-sized enterprises. We are seeing a shift in tax policy, with a focus on closing loopholes and adjusting corporation tax to fund public services. However, the challenge remains: how to stimulate growth without triggering another inflationary spike. The tension between austerity measures to reduce the national debt and the desperate need for investment in crumbling public infrastructure is the central conflict of the current budget. The social impact of these financial pressures is most visible in the rising reliance on food banks and community support networks. Data from the Trussell Trust and similar organizations show a sustained increase in the number of people seeking emergency food parcels, including those in full-time employment. This hidden poverty is a systemic failure where the minimum wage, despite increases, is failing to keep pace with the actual cost of basic necessities. The social fabric is stretching. We are seeing higher rates of debt insolvency and a decline in the standard of living for the bottom 40% of the population. This economic disparity is not just a financial issue, it is a public health crisis, contributing to increased stress and chronic illness across the UK. Energy security remains a volatile variable. While the UK has increased its capacity for offshore wind and solar, the transition away from fossil fuels has created temporary price volatility in the energy market. The energy price cap continues to be a critical shield for consumers, but it is a temporary fix rather than a structural solution. The social impact here is fuel poverty, where millions of households are forced to choose between heating and eating. The government's push for home insulation and heat pump installation is a step in the right direction, but the high upfront costs mean that the wealthiest households benefit first, while the poorest remain in inefficient, cold homes, widening the inequality gap. For the UK's SMEs, the current environment is a struggle for survival. High borrowing costs from the Bank of England's base rate mean that expanding a business is now significantly more expensive than it was 5 years ago. Many entrepreneurs are pivoting toward leaner operating models or scaling back their ambitions. We are seeing a decline in high street retail as consumers shift almost entirely to e-commerce, leading to vacant storefronts in town centers. This hollows out local communities and removes the social hubs that once defined British town life. The challenge for 2026 is creating a supportive environment for innovation that doesn't rely solely on cheap debt. In summary, the UK's financial landscape in June 2026 is one of resilience but fragility. While the macroeconomic indicators may show stability, the microeconomic reality for the average citizen is one of constant negotiation with rising costs. The key takeaway is that financial health cannot be measured by GDP alone, it must be measured by the accessibility of housing, the stability of energy costs, and the real-term value of wages. To achieve a sustainable recovery, the UK must bridge the gap between its high finance success in the City of London and the economic stagnation in its regional towns. The intersection of fiscal discipline and social compassion will be the only way to ensure that the UK's economic growth benefits everyone, not just a select few.